Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I am back here today with Mike Macchiarola, partner at Olden Lane. Mike, how you doing today?
Doing great, Mark. Thanks for having me.
You got it. Glad to hear it. Now, one of the episodes you and I have done, and I can't remember if we've done this two times or just once, but we've talked about the NCUA annual report and your takeaways, and then my takeaways about your takeaways. But that's most of what we're going to talk about here today. But for listeners or watchers who have not seen you or heard you on the podcast before, could you give a little bit of background of yourself and Olden Lane and what it is you're all doing for the system?
Sure. Olden Lane is located in Bridgewater, New Jersey. We've got 9 professionals working here now, and we fashion ourselves as the only, to our mind, investment bank that deals exclusively with credit union and credit union issues. We represent credit unions large and small all across the country. If we've made our name anywhere, it's been predominantly in subordinated debt, where we've done about 60% of the deals that have happened in the last 6 or 7 years by either deal count or dollar amount. We're increasingly moving into the M&A sphere because that's a pronounced need in this environment and in this movement. And as of yesterday, we're announcing, this is a worldwide scoop for Mark Treichel's podcast. As of yesterday, we're announcing that we're taking our talents, if you will, like LeBron said, to Stifel. We will be joining Stifel, Nicholas and Company very shortly. We are tremendously excited about that because our 2 business lines slot in perfectly with what they already have. They're a massive player in the credit union space, and we are just thrilled about what we can do together.
That's exciting. I know, when you told me about that, and it was explaining how what you do and what they do kind of fit yin and yang. I'm going to get part of that wrong. The Chinese is not my expertise, but it seems like it's a great fit, and I'm excited for you and your clients, and of course for Stifel.
Yeah, we've got a lot more capabilities. We've got a bigger team, and we add, smarts all across the board. And we've worked with them on a number of projects over the years, and we could not be happier about the quality of the person we're joining. So it's going to be great.
That's awesome. It's so we're recording this April 21st. This episode will be out April 28th, I think, next Tuesday. And as we're sitting here, I've got my half zip on, and that's it. You referenced LeBron James, so I'm going to reference Peyton Manning. I've got my Peyton Manning inspired half zip because it's really cold where I'm at today. And the NFL draft is on Thursday. Your New York Giants, I think, have 2 of the top 10 draft picks. I'm hoping they screw those up so some guys fall to my Vikings, but
Don't worry, they'll screw it up. Well, how do they say? Past performance is not necessarily indicative of future performance.
I love it. I love it. All right. Well, and so, by the time this plays, more people will know about your merger and how that's all going to work out. And more people and everybody will know who their teams picked or should have picked. So with that, let's jump into the annual report. And, I saw your LinkedIn post, and you kind of broke it into the Magnificent Seven. So I'm gonna walk through the 7 topics you brought up, and we'll kind of walk through that, and then maybe do a cleanup at the end if there's anything else that we still need to chat about. Sound good?
Perfect.
All right. So item number 1, your takeaway from the annual report was that the system is strong, but the tone is cautious and rightly so. Can you dive into that?
Sure. Well, the first thing I would say is that I have a sign above my desk, and it says, "The laws of economics are like the laws of gravity. They are non-negotiable." So that's the lens through which we look at everything here at Olden Lane. And when you look through that lens, you've got to be honest about what's going on. So the count of credit unions, we're at 4287 at the time of this report, down from 4455 last year. So a 3.7% decline. Why? Consolidation mostly, right? We've had a few liquidations in the last year, but it's really consolidation. And with 4,200 left on the playing field, losing close to 200 a year, you can do the math, Mark, on how long we can continue to do that. On the creation side, we talk a lot about de novo. I know Chairman Hauptman cares a lot about de novo, but we're nowhere near where we need to be on de novo, and we're not de novoing, if you will. I'm turning into a verb. New credit unions that are significant in terms of size, shape, and member reach. If we're going to be replacing folks, we need to replace them with credit unions of heft. And frankly, the regulations don't allow it. We can go into how you can grow a credit union, but you can't start big and grow big. You have to start small, and it takes many, many years and a slow growth pattern to get anywhere of size. Asset level, we're at 2.43 trillion at the time of this report, up slightly from last year. Nothing to say there. That's natural growth. Average asset size per credit union, interesting. We've gone to 568 million, up from 518. That's a 10% increase in a year. So our credit unions are getting bigger. Why? The ones that we're losing are on the smaller end of the barbell. So the asset size is gaining. Some good news. The average ROA at a credit union up to 79 bips from 63 bips a year ago. I think that's part of the story. We're seeing repair in the overall macroeconomic picture. Although, again, I'd be a little cautious. We've got 144.7 million members, up from 142 million. I hate the member number. I think we've talked about this before. It's a tough number to put your arms around. I don't know who's a member of multiple credit unions. I don't know how many of these members are true core members in a geography or a seg base versus indirect members or foundational associational members. So it's hard to say anything about a membership number per se. I can tell you that the membership skews heavily to larger credit unions. If you were to plot out over the last decade where the growth is, all of it is in the larger credit unions. The largest cohort of credit unions is growing at about 10% annually over the last decade. The smallest group of credit unions are declining in membership. In fact, the median credit union in the US has negative member growth for the last 6 quarters. New membership per branch is in a free fall. It's now half of what it was in Q2 of 2023. And the cost of acquiring a new member is insanely expensive, about to touch $900 per member. That's up from $400 per member just 2-3 years ago. So there's a lot underneath. I mean, the net worth is healthy at 11.3, but I always caution people, the median or mean net worth credit union is not what you're worried about. It's the one on the low end. And there is some error, if you will, or some artificial bolstering of that number, because there's still tax credits that are in there from the employee retention tax credit. I can tell you, we worked with firms and added $250 million by ourselves to net income. I would assume that the industry probably did about 3 or 4 times that number. And that's still in that retained earnings or in that capital number. The other thing that's in that capital number is the effects of the generational capital that came from the ESIP program. The U.S. Treasury bolstered to the tune of about north of $2 billion, bolstered this industry with 30-year capital. So again, overall, good numbers, but there's reason for caution.
You know what? I wrote down a few different things that you said. The median credit union has shrunk for 6 quarters. That's like a wow statement to me. And I think as you said it, I think of some other analysis I did, and it's kind of a reminder of that. But, and of course, you're a bigger math guy than I am, but the median is the middlemost, right? That's the one smack dab in the middle asset side wise, but to have shrunk in, is it members, right? For 6 straight quarters, that's off the hook crazy, you know, when you think about that. And the odds are those less than that are 9 times out of 10 doing something similarly. The one other item, you know, as you're talking about new charters, I don't know, every time I go to NCUA.gov, I wonder if they're going to change the photo on the front, because the photo on the front is NCUA Charters Haven Federal Credit Union, which happened, I don't know, 3, 4, 5, 6, 7, 8 months ago. They've been doing a lot of things, updating regulations, but they're not dropping that into their headline. They're proud of one charter, and those new charters that come in, some of them survive 2 years, some of them survive 5 years, some of them survive 10 years. Meanwhile, you've got fintechs doing a lot, which we're going to get into. and you've got the Trump administration, appearing to be willing to charter some new banks, which is going to create some more competition for credit unions, and in particular those small credit unions. Yeah, the numbers look good, but there's challenges rolled up underneath and brewing, which goes to that headline of the numbers. I got to pull back. Let's see. I got your notes here on but the tone is cautious, right? That links back to the tone is cautious in my mind.
You've also got, look, you guys like you and I, we dig deep in these numbers. We live in this world every day and we pay a lot of attention to it and we get a lot of inside baseball. But we have to pull back and we have to remember all of these institutions combined are 60% of JP Morgan, give or take.
Sure.
So somebody wakes up on the wrong side of the bed in terms of a policymaker or a real influencer. And we may all be looking at something very different tomorrow. And so, you got to fight like you're somebody told me you got to fight like you're the third monkey and Noah's Ark is only bringing two. I mean, that's kind of what it is every day. And you're doing it obviously for a good reason and on behalf of members.
Absolutely.
But, let's understand the world in which we're playing. And, one of the pieces we did about 6 months ago was, SoFi, which is not a top 50 bank in the US, they gathered as many new members in Q3 of 2025 as the 4,400 institutions that we call credit unions. And that's just staggering.
Staggering indeed.
The other thing is for caution, if you take delinquent loans and charge-offs and add them together, and then you put them all on top of the average loans at a credit union, we're now at about a decade-long high. So the credit quality of what we're holding is still tenuous. Now, it's not breaking the glass kind of nervousness yet, but the trend line is not great. And with that trend line is a lot of the deflating of the air that came from some of the pickup we had because of this COVID relief and some of the changes that happened behaviorally among our members and among our ability to staff things. So OpEx is flying. It's hard to control. We're in an inflationary environment. The biggest contributor to everybody's OpEx is their staffing. And everybody seems to be, not able to reduce headcount and or having to continue to keep, put more fuel in the furnace. And so it's weighing on our prospects.
Yeah.
And then the other thing, go ahead, Mark.
I was just going to say, even though the ROA is up, 16 basis points, that could be eaten up real quick with a little bit more delinquency, 10, 15 more basis points of delinquency that turns into charge-offs, which then hyper impacts your CECL. And CECL will be I was just doing some analysis on how the funding is in CECL, right? And there's some folks out there looking through rose-colored glasses, and exams will eventually pick up on that, right? So, yeah. So you were going to say something. I'm sorry.
I mean, the last thing I would say is, I deal in the world of aggregates in a certain sense. So you and I get together and I say, well, this is my view of the overall industry. The last piece we did on our newsletter, I think it was entitled Everything Has a Season. And the point of it was each credit union not only has to understand where it is in the macroeconomic picture, which again, we can understand in a big way, but also has geographic, particularities. But the other thing is you have to understand where you are in your own business maturation. I mean, how far along in your tech refresh are you? How far along are you in your core that you're going to be looking at a core conversion next year, or you just got it behind you and it's free sailing? Where is your member base and how old are they vis-a-vis where you need them to be? And so what we've said to people is you've got to understand not only the best practices of the industry and where you are in a big, broad macro picture, but you have to understand your own decision-making with a tailored approach that accounts for the specific time, place, and prospects of your business, all of which are unique credit union by credit union.
No, makes total sense. And I like your reference to the Mamas and Papas songs under the seasons there. That's awesome. So now let's pivot to number 2. A meaningful shift in regulatory philosophy is in full swing.
Okay. This is a way of just saying there are Democrats in the world and there are Republicans in the world. And sometimes Republicans take control and have a philosophy and sometimes Democrats have control. look, it's not lost on anybody that this is thematic. It's similar to what's happening in the banking world. We're seeing the elimination of certain things. We're seeing an emphasis on deregulation or whatever buzzword you want to use, but essentially more permissive from the regulatory standpoint. We can argue about whether that's good or bad, but that's a pendulum. It swings. It often swings too far in one direction, only to swing too far in the other direction when we sweep in a new government. But we're seeing things like the elimination of reputational risk, a formal rejection of what they call regulation by enforcement. This is a particular one for Chairman Hauptman. They've extended exam cycles. And we're seeing, I think we saw today, number 10 in the deregulation efforts.
Yes.
Today's was particularly interesting. I haven't read it yet, but certainly I, pulled it out, looked at it.
Yeah. So number 10 was lightening up the rules on credit unions being acquired by banks. And I don't know, Chairman Hauptman, if you're listening, how about coming out or finalizing or providing some guidance on credit unions purchasing banks? That was promised a long time ago in a proposed regulation. Mike, I'm going to go down a rabbit hole here. And in that proposed regulation, it said that we will disclose in the National Supervision Policy Manual how you can structure your packages for acquisitions of banks, and we'll put it in the National Supervision Policy Manual. Well, since then, they haven't done it. They haven't finalized the regulation, which they're not going to do, I guess, because Trump doesn't want regulations, and you can be on either side of where you want to be on that. But the link where they used to actually show a little bit of what they looked at on acquisitions is dead, and it's not redacted. It's just dead. So, which is a whole other issue I bring up occasionally on the NSPM. But and on the regulatory philosophy, in my 7.5 years as executive director, I worked for 4 NCUA board chair, and it swung back and forth, DR or RD. And one of the things that was exhausting for me was when orange was orange one day, and the next day orange was purple, and purple was orange, and having to circle the wagons and go in the other direction. And that's partially the beauty of the country we live in, is that the pendulum swings, and you go too far this way, and you get brought back this way, and in the middle is where the most of us are in reality, other than the fringes. Although the fringes seem to control conversation sometimes. That was one of the things that made me want to depart from government work and get out and work in the real world with credit unions. Not that NCUA wasn't the real world, but that politics side of it, where the pendulum can swing, is pretty dramatic. And the items you raised are substantially different than what it would have been under Harper, what it would have been under Rick Metzger, and the extended exam cycle. I know that staff is a little worried about losing 27% of staff, and delinquencies at the highest point in time in how many years. Charge-offs are high, and the agency is pushing innovation, which is great. Innovation, you need to innovate or die, right? But having less people to look at that and then going in less frequently is a recipe for insurance fund losses and credit unions, smaller credit unions that are going to go away. And again, that's just, it's part of the cycle.
Yep. No, I agree 100%, but we see it. Those of us that have been around long enough are sort of somewhat used to it, and just, again, have your head on a swivel and understand the environment in which you're playing. There's not much to say other than, that's kind of understand, how the deal is dealt.
Yeah, right. You gotta, everything in life is a game with rules, right? You got to figure out the game, figure out the rules, and then figure out how to succeed.
Yep.
So item 3 on the Magnificent 7, innovation is no longer peripheral. It is central to the agenda.
I mean, look, it's difficult for a regulator to do much here to sort of push the horse out of the barn, but they're doing as good a job as they can. They're telling you, look, you're going to have to innovate. To your point earlier, let's take Stablecoin, for example. They set out in early 2026, some rulemaking, trying to remove the ambiguity, trying to tell credit unions you can embrace it. It's not permissible, albeit through a subsidiary, signaling that they're not prohibited. they're legitimate, and, go get them and don't complain that others are doing it faster, because it's not going to really be the NCUA that's in your way. Of course, there's a lot of other things to navigate here, including a coordination problem and an understanding about your own bigness and your own ability to survive with a coin that may not get adopted on a broad scope. But again, it's early days, and here's where the regulator's doing the best they can, and we've seen it time and again. I mean, we saw it in derivatives. The regulator was actually faster to tell people to use them than the people were to adopt them. And those that understood it, can read the tea leaves, and got in front of it were probably helped when we had the interest rate volatility that we had. I believe the NCUA was early on the permission to up the ability to take non-member shares. They upped that limit earlier than people needed it. And honestly, when people did need it, it bailed them out of a hell of a lot of trouble.
Yeah, great point.
And I think we're slow to give credit to the regulator, where the regulator is actually further down the road than we're willing to adopt. So again, I think them signaling out loud that, we're open for innovation. Of course, Chairman Heltman has been a proponent of everything, innovative, from crypto to stablecoin to anything in between. Certainly will love to have those conversations, and is not shied away from embracing people who want to get into that realm in a responsible way. There's a lot of work to do. It's still early days. Just by nature, their size, their shape, credit unions are not going to be the tip of the spear at the innovation here, most likely. But you got to be a fast follower, and you got to understand a path, and you got to keep an eye on it, because, otherwise you're going to be, swept away.
Great point. And I saw Chairman Hotman speak at GAC, and he talked a little bit about crypto and stable coins, and made a reference that I hadn't heard before, and then did a little bit of research, and it's a narrative that I am growing to understand, but essentially that if stable coins help the US dollar remain the focal currency in the world, that's a positive thing. And I think, to me, that's a better use case than I've heard from other things where people are thinking stablecoin. It is going to make sense. And then earlier last week, I was listening to the FinTech Takes podcast, a great podcast out there. And there was a passing reference to North Korea stealing 70 or $80 million of stablecoin from a provider within like a 7-hour window, where they hacked it and took it over. And now this money is in North Korea. And I'm thinking, well, I thought crypto and stablecoin were supposed to be like the most ultimately secure thing and better than all the systems we got now. And if you don't have that with stablecoin, what do you have? So I took a screenshot of that podcast. I'm going to go back and try and research that for a future episode. But that kind of didn't surprise me, but it surprised me.
Yeah, I mean, there's two things I would say. One is, I have long designed it this way, but when you look at the collateralization and the requirement that it's supported by treasuries, you can back quickly into an understanding that it creates demand, albeit, artificial or real demand for US treasuries, probably, that otherwise wouldn't be there. And that is a defense of the US dollar. And
Right.
that's probably not by accident.
Yeah. It took.
Second thing is, I've always,
I'm glad they're talking about it now, is because I was always trying to figure out, so what does this really do? If that's what it does, it's awesome.
yeah, the second thing I would say is, look, like every new innovation technology, there's always a blow up. Someone, we're going down the highway, everything looks great, and someone blows a flat tire, and it is what it is. And they'll be the poster boy, and then we will address it and understand it and fix
Sure.
it, repair it, and hopefully have a better, smoother ride going forward. But look, it's being adopted quickly. It's certainly got legs. And again, the whole thing could come to a screeching halt if we change administrations and they change their view on it. But for now, you've got to understand where you are in that ecosystem and have a plan of some sort.
Sure. And remember, there are no blockbusters and there are no horses. When you go outside, you're not going to see any horses and buggies unless you're in Pennsylvania. Let's pivot to consolidations. So consolidations continue. We touched on that a little bit, but there's a lot there to unpack.
Yeah, I mean, look, we've talked about how many are disappearing. They're disappearing either, mostly by consolidation. The charts are kind of crazy. There's a few things you have to understand in the background. The first thing is, even with the numbers that we have, even the good credit unions, we're sort of a little bit miscast. One of the things that we're discovering here is that the average age of a credit union member is just simply too high. It's sitting at 53 today. The average age of a US person is 38 and a half. So we're aiming at customers who are older, and that's not per se bad, except when you start getting into the habits and whether they make a good customer for a financial institution. Baby boomers represent the largest share of credit union members. Today, they're about 39% of credit union members. That's up from about 28% a decade ago. And credit unions are falling behind in new account openings. If you asked respondents in a recent survey, did you open a new deposit account? 10% of those people opened it at a credit union, and that's down from about 16% a few years ago. So what does it mean? It means that the group that we're facing are in the baby boomer generation, and we talk about that generation as being between 62 and 79 right now. 62 is important. It's the age of retirement. 79 is important. It's the age of life expectancy. So if you're in that group, you're not a great banking customer in reality, because you're drawing down savings. You're not adding to savings. You're giving away your savings to the next generation, and they may be going to a different financial institution. And you're not originating loans. So in terms of profitability, you're not a great solution for credit unions today. So the answer lies in finding the younger customer who you gain some lifetime value with. And here, the numbers are startling, because while we have a big advantage, we're sitting on $2 trillion of deposits in the credit union space. FinTech's up to about 127 billion. When we look at a basket of FinTech, it's SoFi, Robinhood, Wealthfront, Coinbase. None of them have massive deposits yet, but what's scary is the way in which they gather deposits and the competition and how it comes from. So those names I gave you, SoFi, Robinhood, Wealthfront, Coinbase, together they have 0 branches. Credit unions together have 20,000 branches. It's going to cost us a lot more money to acquire members than it's going to cost the digital-only alternative. And let's look at the member growth. The member growth in the credit union space by mean is about 1.5%. The digital composite that I just gave you, those same group, 15% growth last year-on-year member growth. SoFi itself grew members by 38% last year. Robinhood 7, Wealthfront 16.9, Coinbase 10%. Numerical member growth, the digital platform grew by 6.3. Credit unions only by 2.4. And then you start looking at that and you say, okay, we've got a great head start, but our acquisition costs are higher and our growth prospects are much slower. So over time, I don't have to be a genius in mathematics. And again, I tell you, the laws of mathematics are laws, they're not suggestions. We're going to get caught and we're going to get passed. And it's only going to accelerate. Short of kneecapping them, which I wouldn't recommend and I don't think is street legal, we've got to up our own game. And so we've really got to start addressing, how do we face customers? How do we gather customers? And that's going to get us, we're not there yet, but I think later in this discussion, we're going to get to a bigness question. And we're going to get to, am I right at facing customers and potential customers, members and potential members? And if I'm not, how do I address that? And can I do it by myself organically, or is it going to take something exogenous?
Thought-provoking, a lot packed in there. You mentioned Robinhood. I think I heard that the Trump accounts, the $1,000 that kids are going to get, are going to be, I don't know if pigeonholed the right way, but they're going to be pushed towards Robinhood, which is,
I think it's Robinhood and Baldy.
What
I think Bank of New York has a piece, but I think it's Robinhood.
And you're right. It is Bank of New York and Robinhood together collectively are going to, one's the safekeeper, or what's the term you write into those deals? I think it's the safekeeper, but Robinhood's growth is going to be more than 7% if every kid gets an account. No, by the way, they're kids. Those are the youth that we're talking about. And as you were talking about that, I thought about another stat I heard in a podcast where it was a larger bank had done some analysis about what their members were and where they were weak, where they were strong. And when they got done looking at it, they realized they had more 90-year-olds than 19-year-olds.
Oof.
And
That's not going to last long.
yeah, right. Yeah. That's not going to last long because those 90-year-olds are 11 years beyond the life expectancy already. So,
11 years of borrowed time. I hear
right.
you.
Yeah. Yep. Was it Pink Floyd said shorter of breath and one day closer to death. Okay. That's a little macabre, but that gets into mergers, right? Very good. All right. And consumer protection remains a steady underlying theme.
Yeah. I mean, look, you know, there are consumer complaints and inquiries, and there were a fine number. I think there were 49,000 last year. They handled them well, at least according to their own annual report at the NCUA. The bottom line is this is going to be de-emphasized, and again, it's probably politics, and this is a subject that Chairman Harper cared a lot about, and Chairman Helpman doesn't care as much about. You know, and I'm not saying he doesn't care about it. I'm saying it's not a point of emphasis. And so what I wrote in the piece is the takeaway here is subtle but important. The agency wants credit unions to believe that the priority has not diminished, but the allocation of attention tells us otherwise. So do with that what you will.
Yeah, it has been de-emphasized regardless of what they say there, and it is the politics. And in my mind, one of the things that happens when that happens is the states can still pursue what they want to do. And so the burden, like with the CFPB not being funded and them not being able theoretically to do the mission that they're charged with, right? With them doing less, what happens in courts and what happens in the individual states can override and take the momentum. And what I anticipate obviously would be whenever there's a transition back to a D is they'll jack up the funding of CFPB and credit union exams will have more consumer protection teeth to it. Although they haven't, Harper had expanded on that. NCUA had never really pursued that to the extent of the banks with their separate consumer compliance exams, et cetera. All right. So next up, technology and cybersecurity remain front and center.
Yeah, not much to say here. I mean, obviously, you've got to keep your cybersecurity PQs up. These things are ever evolving. The AI and agentic AI make it even more difficult, and we got to continue to make that fight a fight that we win every single day to protect our data, to protect our customers' information. One of the things I always find interesting here is I think there was some more jawboning about the NCUA wants and needs the tools to go after credit union service organizations, CUSOs. Kind of funny because number one, I don't think it's in the political cards. And number two is it's really interesting that they're asking for more to do at the same time as they're extending the schedule of exams at credit unions themselves. So it's really like, be careful what you ask for, stick to your knitting and stay in your lane. You know, they're not going to get that. And I know they know they're not going to get that.
Well, and as I said, when I was executive director to somebody who was recommending we put that on our agenda, I said, I see what we're doing here. If it blows up, we asked for it, or no, we're not going to get it. And then we can say, we told you 18 years in a row, we needed more authority. And you're not going to, and that's why it's there. They know they're not going to get it. They got to ask for it because it's an authority that if they had, they might be able to do something. Might.
Exactly.
Might. Very good. All right. So the agency itself is changing structurally and operationally.
Couple of observations. As you pointed out earlier, it's not technically a reduction in force, but they had about right around a quarter of their people take the plan and exit the agency. That's, of course, going to have knock-on effects on everything they do. They've reallocated resources toward technology and efficiency initiatives, and kudos to them for doing that. I think they've been pretty good about that, honestly. They continue to streamline a lot of internal processes, and again, kudos for that. More importantly, look, let's get myself in some trouble. Chairman Houtman has been a good soldier. He's staying past his appointed time because someone has to guide the agency. He did point out at one point, if he just left, it would be 0 on the board. I will tell you, I was down there for a board hearing a few weeks ago. It was very strange to be at a board table where it was Chairman Haltman, one glass of water, one gavel, one chair, and then I was on the other side of a massive table. It was a very strange board meeting, but there I was. So, look, former Chairman Harper is entitled to his day in court. He has a justiciable claim, and good for him. I wish we could make an arrangement where he probably started to understand all he's going to get if he won, and I don't think he's going to win, but all he would get is a Pyrrhic victory anyway, because time is pushing everybody's timing out anyway. Again, the president is kind of boxed. I can see why he doesn't want to make his appointment, but he probably should get on with what he needs to do, whether it be one appointment or 3 appointments, just to allow the agency to move. Again, if you compare it to banking, and we were at a banking conference, one of my colleagues and I, about couple months ago in Arizona. Banking, the message was clear. The window is open. We don't know how long it's going to be open, but do what you need to do, whether it be a merger or it be a reorganization or it be anything that needs the permission of the agency. We're not even there yet because we've got, by virtue of the reality of what we have, a lame duck leadership that's doing its best, but is kind of boxed. We have a president who's boxed on his appointment. And we're losing time. We're losing that window whereby we would have this wind at our back to do the things we need to do to get in shape, to right size and to do some of the permissible activity. We're by definition being slowed down, and that's unfortunate for the credit unions.
All great points. I was in charge of a reorganization at NCUA where we closed 2 regions. And I think I was proud of how we communicated it. I was proud how we handled it with staff. And at the time, I would always refer people to a Machiavelli quote. It's just not a person you want to quote in theory very often, but the quote was from The Prince, which was, "It must be considered that there is nothing more difficult to carry out, nor more doubtful of success, nor more dangerous to handle than to initiate a new order of things," in brackets, a reorg. "For the reformer has the enemies and all those who profit by the older order, and lukewarm defenders in those who gain." And I can tell you, I experienced some of that when I led an NCUA reorganization. And I can tell you, the rumblings out of NCUA is those that are losing aren't happy. Those that are losing are doing more with less. Those who are gaining aren't happy. And then when you layer on top of it that they have not communicated to the industry what they're planning on doing, and they are, I don't want to say hiding behind, but they're saying we have to negotiate with the union. And now out of nowhere, they say that they're going to finalize it in 2027. So is that they really need to finalize it in 2027, or they don't want to talk about it now and they want the next board to do it? That's someone who left NCUA, who's talking to people at NCUA, theoried that to me. I don't know if it's true or not, but I will tell you the morale is challenged. Any place that goes down 27% is going to be challenging. Then when you're told this is what the reorg is going to be, and then it never gets finalized. And, this might be an instance where the union is doing some things. I tend to think maybe not. But anyway, all right, I went down a rabbit hole. You don't need to comment on that, but you're more than likely, you can if you'd like.
Well, the only thing I would say is that hopefully we've improved from the transition of Machiavelli to Macchiarola, because I'm hoping that our reorganization into Stifel goes a lot better. It's far so good.
But that was perfect, man. That's awesome. Very good. Very good. So, bigness. Let's talk about the law of large numbers.
Yeah, here's where, look, again, sometimes my job over here is to deliver what my father would say, tough love. And honestly, this comes from love. It comes from a deep desire to protect the overall franchise that is credit unions. And we've got to be smart about how we allocate our collective resource. And when I look at numbers, and we do this every quarter, and Ryan Marquardt in my office is the guy who gets me screaming at him from the minute they're out to get me all these numbers fashioned all kinds of ways. But what we try to do is we try to break things down by tier group. And so, the under 100 million, the 100 to 500, however we decide to sort them, we're sorting them by size. And the numbers are just staggering, Mark. I don't think people truly appreciate like a few things to look at. Right now in the credit union system, if I were to just take the people who are under 500 million of total assets, that group of credit unions makes up 73% of the count by institution. And collectively, they have 13% of the assets in the system. So how does that express itself? Number one, as a regulator, it makes it difficult, right? Because now I have to send resources all over the place. The second thing, the 21 credit unions that are in the $10 billion plus club, they have 25% of the movement's assets. So we've got to address this. Now, here's the other thing. Every single financial ratio you look at improves with size. So the OPEX at the under 100 million is a full point higher than the bigger credit unions. The ROA is lower. Here's one that, the loan to share is lower. This is the definition of what you're supposed to do. You are a credit union. Your job is to extend credit. And I understand why when you're smaller, you have to have a margin of safety and you can't lend as frequently or as much. But we're at a 61% loan to share on the under 100 million. We're at 85% in the over 10 billion. So what are we trying to achieve in this movement? We're trying to extend credit to people who need it. The better extender of credit is the bigger credit union, because all of those efficiencies that come with bigness, that come with the law of large numbers, that come with the diversity of a bigger portfolio, that come with the spreading of costs over a larger base of assets, that all accrues to the benefit of more lending. It also means a better dividend for the members. The dividend grows with size. So it's just difficult to reflexively defend the smaller credit union time and time again. I get it. I love them. We work with them all. But you've got to be able to deliver value, and that value has to be expressed in the numbers. Then the value has to be in, am I giving them better loan rate or a better deposit rate to my customers than the guy next door? Whether the guy next door be bigger or smaller, because that's the competition. And the guy next door, incidentally, is not the credit union next door. It's the credit union next door. It's the community bank, and it's Robinhood or SoFi or Chime. That's the reality of the bigness question.
Challenging time to be a credit union, more challenging to be a small credit union. 73%. The credit unions are under 500 million, I think is what you said, which is 13%. And then the top 21 are twice that in percentage. That pretty much says it all.
It is. It's remarkable. It's remarkable.
Any last thoughts as it relates to, that's a great place to end, but is there anything we wanted to talk about here relative to the annual report or anything else before we wrap today's episode?
No, again, the agency's doing what it's supposed to do. The report tells us that. I think they're emphasizing and hitting on things that they think are important. And, I think they're pretty much square on. We can argue at the fringes. But again, I think from the outside, whether it be the president or Chairman Harper or Chairman Hellman, somebody's got to figure that out to get the next appointment in the chair and to get us moving, with some alacrity.
I like it. And if someone is listening and they want to chat with you about how you all help credit unions, what's the best way for them to reach out?
Well, for the next few days, they can reach us at Olden Lane. We have a website, www.oldenlane.com. That will remain functional for a little while. I'm certainly fairly prolific on LinkedIn, although those rules will probably change for me shortly. And, we're Dan Prezioso, myself are pretty, accessible within the ecosystem of credit unions. We're looking forward to the change that's coming for us, and we'll be back to you with our new names and addresses.
That's right. Yeah, we got to get those new email addresses, and you're still going to be in the movement, and you're going to be able to help more credit unions under the new structure, as I understand it. So
Absolutely.
that's setting. All right, Mike. Well, thank you for your time as always. I enjoy chatting with you. I hope your Giants do stupid things on Thursday. And I hope my Vikings hit it out of the park.
Awesome. Good luck.
Yep. Thanks,
Thank you, sir.
And listeners and watchers, I want to thank you for watching or listening. I hope you'll do the same soon. This is Mark Treichel signing off with flying colors.